We've only gone over a couple of different Iron Condors so far. Even though there's probably dozens of different ways to set up these trades, there's many different ways to tear them down, to risk manage them, to set them up in an asymmetric format. But there's a third one that I'd like to cover with you here, which is not as far out as a high probability Iron Condor, and it's not quite as close as a low probability Condor. It's kind of a hybrid between the two, and it's what we call an expected move Iron Condor. An expected move is one standard deviation in price. You've all seen the normal distribution curve before, the old bell curve that we talk about. Well, this is really talking about the very center of the bell curve in this case, or the normal distribution curve, which is represented by one standard deviation plus and minus. And so this gives us a 68.2% probability that the price will stay within this central part of the distribution curve. One standard deviation means that the price will have a 68.2% probability that the price will be within this range of an Iron Condor. There's nothing magic about this number. The high probability distribution percentage was about 81% if we're dealing with 10 delta options. The low probability distribution percentage was 50%, and so this expected move Iron Condor is about 68.2. It's kind of a compromise between the two different Iron Condors, the high probability and the low. So it's kind of a hybrid type of Iron Condor for the zero DTE trades. You might be asking at this point, how do I figure out this one standard deviation? Is it something that everybody knows? Well, yeah, it actually is quite a common metric to use when talking about price movement. So I'll show you a couple of different ways to get this because it is going to be a little bit broker dependent. Some brokers make this really easy to find, some make it quite difficult. So there is always one wild card way to figure this out or get a pretty close approximation to it. So first of all, with Thinkorswim, we can simply just choose the option series that we want. And if we go over to the right-hand side, we're going to see the implied volatility at the money for that series, as well as the expected move right there. So the number all the way to the right. And so this is a plus minus 25.091. You can always tell it's an expected move number because it's going to be designated with the plus minus on there, indicating that it's really about a 50-point range is the expected move into 3 days from now. Now, different brokers will have different numbers depending, especially as we deal with a weekend. So I can bring up the same series here for Tastyworks, and if I go over to the right-hand side, I'm going to find that it's a slightly different number, in this case, about 18 instead of 25. So plus minus 1834, and I suspect that it has something to do with they're already discounting the weekend out of this. Since they don't trade over the weekend, Thinkorswim is going to count that number down all 3 days, Friday, Saturday, and then Sunday until Monday, whereas I believe that Tastyworks is already discounting that number and saying this is what we estimate is going to be there available on Monday morning. Now, what if you have another broker? What if you're using something like a Robinhood or E-Trade or any number of these other types of discount brokerages? You don't have that expected move number. What can you do? You can approximate this with the at-the-money straddle. There are ways to fine-tune this to make it a little bit more accurate by adding the at-the-money straddle, the at-the-money strangle, but let's just do the simple thing. Let's do the at-the-money straddle. Right now, the price is $33.97. So what we want to do is to get the at-the-money number, which in this case is going to be $33.95. And what we simply need to do is to add up the puts and the calls at this price. So if we add the midpoint together, we can see this is about 1070 for midpoint. And then if we add the puts onto here, it's going to be about 970. And so that's going to give us a figure of $20.40 for the expected move. So it's not that far off. It's not that far between. We have 25 on the high side from Thinkorswim, although I guarantee by Monday morning this will be showing different. We have 1834 is the expected move by Tastyworks, and then the at-the-money straddle is 2040. Okay, great. What do we do with this number? Let's say we're going to use this number of 18. What do we do with it? This indicates where the short strike prices will be. Let's go to more strikes here with Tastyworks. Let's go to all. So again, we're going to start maybe at 33.95. If we subtract, let's just say 20 points. If we subtract about 20 points, that's going to give us 33.75 is going to be our short strike. And if we add 20 points to this, this is going to be 34.15. So 34.15 and 33.75 would be the expected move short strikes for an expected move Iron Condor. I'm going to go back to Thinkorswim for a minute and just show you something so that we can build this trade in the analyzer. Now, another shortcut is to just look for the 20 delta options. That's going to be really close to one standard deviation away. So the 20 delta options, were the strike price, which is closest to 20 delta, is going to give you approximately that one standard deviation movement. And this is important because when you're setting up a zero DTE, you don't want to be sitting there going, okay, the current price is 33.97 and I have a 25-point expected move, so I need to subtract that from 25 from 33.97 or add that to 33.97. The mental gymnastics, it's too easy to make an error, and you're trying to get the trade in, right? You're trying to get it in so you can capture that time value decay. Don't want to be messing around with that. So what I typically will do is just look for the 20 delta options. So let's go ahead and do that. Let's set this up in the analyzer and see what this one looks like. So we're going to find that this one is pretty close to what we just did in terms of the exercise that we did with Tastyworks. So let's analyze selling this trade. We're going to sell an Iron Condor. And we're going to be using a 33.70, 33.65 put spread. We're going to sell the 33.70. We're going to buy the 33.65 put option. That's our put spread. Now we need to adjust the strikes up here. And the closest option that I have to a 20 delta is, it's at 34.15 again. It's at 21 delta. And so I'm going to change this to 34.15 and 34.20 for the long option. 34.15 is the short option. 34.20 is the long option. And I'm going to find typically about $1.50 to $1.80 credit or so. This is showing a little light right now, but that may perk up by the following Monday morning. So that's very, very common to see something around $1.50 credit when we set these things up in the morning. Okay, so let's go over to the analyzer. Let's see what this one looks like. And just like what we're talking about, it's a hybrid between the high probability and the low probability. So there's a little bit more risk here than a low probability. The strike prices are a little bit closer together than a high probability. Now, what I like about this trade, again, is it's a compromise. It allows me to get some strikes a little bit further out, and those expected move numbers are really used. Everybody sees them, and quite often we will see the price coming up and testing those limits of the expected move during the day. So this is the type of trade where I don't want to necessarily have a stop, which is like, okay, if I see the break even get hit on these, I'm out of this trade. So if I see this break even, I'm not going to do anything. And what I tried to do is I try to size these so that the risk, which is here, this R value, in this case, about $360, $370, is equivalent to no more than 2% of my account value. So if we're using the SPX, that's going to be $18,000 to make sure that we can just ignore this and just let it go. So a lot of times I will treat these trades as if they're a low probability and just let them go. Don't have a stop loss to them. Let the price trade, and then look for opportunities to take the trade off when I've reached my profit target. Now, I will shoot for $100 on these things, and it may take 3 hours of time value to go by before I get that $100 profit to show. So it can be an exercise in patience if you want that. You can always shoot for a lower profit target, maybe $50, $60, $75, whatever time that you have available for this. If the price is just staying nicely within the center range, and this is a pretty decent wide iron condor, if it stays within this range, and especially if it slightly favors the downside, then it may take a little bit less time for you to earn your fair share. Now, once again, if we step into a trend day, if it's clear that the price is doing one of these things and it's well outside the opening range and there's no stopping it and the market internals are super strong. So in other words, if we really blew it on the trade entry of this, or if there was some kind of news or some kind of event that came along after we'd already properly qualified this as a range day, if all of a sudden a trend day kicks in, and it will happen, then we can simply just say, all right, no mas, let's wave the white flag, let's just shut it down, because there's a big difference in the cost of this if we shut it down early versus waiting a little too long, and you don't want to take a 2% hit if you can avoid it. Now, all of the same things that we talked about in terms of pre-qualifying the trade does still apply. If you are a random walker and you don't believe in technical analysis or charting, or you don't believe such a thing as candles exist, then go ahead and enter as soon as you possibly can to capture as much possible time decay as you can. That means that you'll probably get something like $1.80 or $1.90 credit when you enter this. You'll have more to work with, a little bit higher credit. You start your slide down the hill from a slightly higher altitude, which is good. But again, you can step in front of a trend day and you just don't know it yet. And that is the compromise that you're going to make. Or you can be discretionary. You can wait to ensure that the price is trading nicely within the opening range, behaving itself before you place this. You're not going to lose that much credit. You'll be looking at probably something like $1.40 or $1.50 entry at 10:15 if you do it that way. Either way, whichever makes sense to you, as long as you don't bounce back and forth between the two methods, as long as you pick one way to do this, commit to it, and commit to getting better and better and better at pre-qualifying your entries. So that is the expected move, Iron Condor, for the Zero DTE trades. It's not only something that you can use for 0 days to expiration, but you can use this 20 days to expiration if you want to. It's just a different form of Iron Condor and a nice hybrid, a nice compromise that I use quite often.